Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have Spencer Gray with Gray Capital. How you doing, Spencer?
Hey, doing great, Lance. Appreciate you having me on.
Yeah, I'm glad we were able to connect and get you on the show. So,
Absolutely.
So Spencer and Gray Capital, they are a recent new member to the Verivest Sponsor Network. So we've been got him on. So been a few weeks waiting to get him on the show. So happy to have him. Why don't you share a little bit with the audience about kind of how you got into the real estate game and what ultimately led you to forming Gray Capital?
Yeah, no, definitely. And, we were just mentioning a little bit about this before the show, but, I've sat in multiple seats, from being a limited partner, co-sponsor, co-general partner. But, really kind of the origin story on how I got interested in real estate in the first place kind of goes back to when I was still in high school. I had a friend of mine whose father was flipping houses, and he essentially kind of roped me into a project they were working on. And I knew nothing about real estate investing other than I knew that it was interesting and people could make money doing it. And of course, this was just prior to the great financial crisis back in 2006. And so, that project wasn't that big of a success, but it kind of planted that first initial seed of wanting to learn more about real estate. And, I'm a very driven kind of entrepreneurial type person. I always wanted to have my own business. I saw my parents build a company, from scratch. And, so I pursued, a number of different kind of entrepreneurial pursuits, and always was kind of doing real estate on the side. I was always kind of looking to flip a house or in the process of flipping a house or, talking about it. And, I liked that because it was what I knew. It's what that first deal was. But I didn't like kind of the grinding of always looking for a deal and the risk and not knowing when we could sell it. And I still had those pain points that I had learned from kind of that when we had that first deal, having the great financial crisis and just the fact that the market can turn. And I didn't like playing musical chairs. I didn't want to all of a sudden be holding a deal when the market dropped. And so I eventually started a business totally unrelated to real estate. It was actually in the craft beer industry, supplying brewers hops and hops products. And that was a successful business. We were moving to sell it. And the reason we were selling is it just wasn't a very scalable business. We were successful, but we really just couldn't figure out how to continue to scale it. And when I was trying to figure out, okay, what am I going to do next? Real estate just kept coming to the top of my list, and I was trying to understand strategies and where I could really build a business, but also create passive income and, cash flow and generational wealth. And so that's when I really took a deep dive into buy and hold multifamily assets and basically decided that's what we wanted to do. And went from there, started as a kind of co-general partner or a co-sponsor on some projects with some local operators, as well as just being a limited partner with several other operators, really just trying to learn what the process was. Because, I knew what I knew, but I knew there was a lot that I didn't know. And by, leveraging the experience, systems of others, we were able to build our own portfolio as well as, leverage that experience into the point where we could build our own systems, build our own team, and start doing our own projects. So that's what we're focused on now. And, we're enjoying it and I love doing it.
Yeah. And you guys are in Indianapolis, is that right?
Correct. Indianapolis, Indiana.
Got it. So is that where you look for most of your deals in the local area, or do you have other markets that you're looking at?
We look at other markets. Indianapolis being our backyard, it's where most of our attention and focus is spent. It's our backyard. We're never going to know any market better than we know, our home market. And then also Indianapolis is a really excellent market. It's got great fundamentals. It's a growing and emerging market. But what we like about it also is that we feel like we're taking advantage of a little bit of inefficiency in the market just because there's just not the flood of institutional capital and capital in general flowing into the Midwest compared to Southeast markets and the Southwest markets and those Sunbelt markets. So we can get a little bit more yield in the Midwest, but we're still in markets that are growing at rates very similar to some of those kind of growing and emerging Sunbelt markets.
Yeah, that makes sense. So for you, like you mentioned that the transition you made as of course co-sponsor and LP, learning from others. I mean, what was the biggest thing you learned that maybe you didn't expect to learn in doing that, or what was like the thing, or maybe that you didn't think was as big of a deal that turned out to be a big deal? I'm always curious, like, what are those aha moments that you go through?
Yeah, I mean, there's a lot, but a couple that come to mind is, and this is true kind of throughout business, but how important the actual people on the ground in the deals that are actually running the properties are to the success of the project itself. I mean, sure, the sponsor is absolutely important because they're going to be the ones that are placing those people at those properties, who's going to be on site, the on-site team. But to see, we had one project that we purchased back in about 2016. It was a value-add deals built in the early 70s. This is in Bloomington, Indiana. And, we had a hard time really just pushing the business plan forward. And it wasn't until we let that on-site manager go and brought somebody new in was that deal was then able to just kind of explode and really start to gain traction. Because the old manager, she had been employed by the old owner and, didn't believe in the business plan. She didn't like the fact that we were, raising rents, and so she wasn't really motivated to really execute the strategy. We put the right person in there, and it was a completely different experience. So that was, one, key piece, that it's not just, sure, it's the property manager, sure, it's the sponsor, but, who actually is at the property and on site. That's incredibly important.
Yeah. So in that case, like, was it it was a third-party property management firm, but then that person was on the payroll? Is that...
Well, no. So this was a project we had co-sponsored, and the group that we had co-sponsored with, they have a vertically integrated property management firm, but it was just the employee, of the property management firm, the operator we had partnered with. Just that on-site employee just wasn't cutting it. And it goes back to the old saying, slow to hire, quick to fire. If it's not moving, sometimes you kind of have to move those people around to really just get the right individuals in the right positions.
Yeah. Do you find that do most people attempt to? I mean, what's that process like? Deciding whether or not you retain the existing, on-site staff members or not? Like, do
it's
people?
Tough.
Is it like treating it like it's a whole new rehire, and you? I'm always curious how that works.
Yeah, it's tough because on one hand, there's a lot of institutional knowledge, or you'd like to think that there's some institutional knowledge.
Yeah.
When you go in and the first day you take over a property, you hate the idea of not knowing, just the basics of where everything is, where do they store certain things, just what's gone on the property and the history over the past, year or 2 years. And so, that certainly is valuable, but that institutional knowledge, can only be worth so much if they're not really willing to, execute the strategy. And sometimes, the folks that are working on site, they may have only been there for 6 months or 3 months, and that institutional knowledge isn't really there. So you really do have to approach it from kind of a new hire standpoint, re-interview everybody currently working at the asset, and really examine whether they're the right people to continue to take the asset forward, or if you really need new kind of some fresh blood in there. And sometimes it's not the manager. Sometimes you want to keep the maintenance supervisor, or that one maintenance tech that has been there that's doing a good job, but maybe you're replacing the actual management.
Yeah. And then for you guys, when you're out there looking, your acquisition criteria, I guess, is what I'm getting at. So like what's your sort of box? I know you mentioned before the show that it's been, super competitive. It's hard to it's hard to win deals.
Yeah.
And I'm assuming a lot of that comes out of the fact that you have specific criteria. So when you go to underwrite it, if it doesn't meet that criteria, then you have to punt it. So
Yeah.
maybe give us some insight into, what that looks like, how you source the deals, how those opportunities land on your desk, how you go about, tearing those deals apart, underwriting them, and just curious how everyone does a little bit different, but I'm always interested in how they go about that.
Yeah. So we have two specific acquisition strategies or silos, a value add silo as then a core plus silo. And, there can be some overlap, but we kind of look at the two a little bit differently. In terms of like our value add silo, we're not ones who go in and do more really opportunistic projects or severely distressed assets. We want to be able to go in and be able to produce some cash flow at acquisition. And so what we're really looking to identify is properties that have just been undermanaged. It's a mom and pop owner who have owned the property for 10 years, maybe 20 years, just haven't moved the rents in the last decade, and there's just so much meat on the bone. Now, that's a little bit of a unicorn that can be really hard to find with all that potential. But if we can go in and add, $500 to $7,500 per unit in upgrades, whether that's renovating, replacing the floors, refinishing cabinetry, adding new hardware, curing any deferred maintenance, and then if we can get a lift of $100 to $150 of rent, then that usually can pencil out a deal. When we're shooting for around a 15% IRR average, 8 to 10% cash on cash over the hold period, which is increasingly difficult to do just in the market environment. Because where we usually could underwrite a deal conservatively to pencil out to a 15 IRR, those same deals in today's environment are looking closer to a 12 to a 13% IRR. And so we're just having conversations with our investors. Is that a comfortable return? And out of the alternatives that they could go, is that worth it still allocate their capital to multifamily real estate with that return profile? I mean, we could still underwrite a 15% IRR. I mean, you can use some assumptions to give yourself whatever IRR or equity multiple you want.
Yeah.
But if you just stick to being disciplined, it is what it is. Now, can we overshoot it? Sure. I mean, we've very rarely done a deal where we have underwritten above a 16% IRR. All of our full cycle projects have been over 20% IRRs, but that's because what ended up happening is something we never would have underwritten. I mean, every investor we would have shown it to would have laughed at us, because if we're buying a project for a 7 cap, 5 years ago, to say that we're going to sell it for a 4.9 cap, we get laughed out the door. But has been what has happened. And so will that continue? Maybe, but probably not.
I mean, it was a good run, and obviously that made it easy when you're not underwriting for that exit cap. But then when people are willing to trade at that number, that was good. And I think it's interesting you bring it up, right? Because you sort of have that investor expectation that the magical sort of 15 IRR, but one has to ask himself, well, okay, is that what one should expect to be compensated for what really constitutes light value add? One could argue that was a bit of just a premium from riding the wave. I mean,
sure.
that tends to be sort of where I land on it. Was just like, be thankful that were alive to, and or invested during that phase of the cycle where you could get that. It was above average risk adjusted return, which real estate market, they cycle, so it goes up, it goes down. One would expect that that in the times it's going up, that you should be able to ride the wave and get an above, be compensated for more than the risk than you're taking. Now when it comes back down, you've got to change your expectations, right? But it's all about that, balancing that risk though at the same time, to make sure that you don't, I think to overpay obviously can be bad, and then if you can't move the rent, so they go the other way on you, you could get stuck, right? But still, like 12 on a pretty light value add. I mean, $7,500 a door or $5,000 a door or something like. That's better than a stick in the eye.
Yeah, that's true, and part of the way we look at it as when we're underwriting a deal is, okay, what's the worst thing? What's the worst case scenario? And in that worst case scenario, okay, so we're not getting our rent growth. We've got, flat or just slightly, our NOI's, basically growing with inflation. We don't get the exit cap that we want. It's adverse market conditions. Okay, so what does that look like? And are we comfortable with that? A lot of times that ends up, you're getting a, 10% IRR, maybe it's 9 or maybe it's 11. Okay, that's not what we're shooting for. That would not be a success in our book, but like you said, it's better than a stick in the eye. And okay, 10% more or less average, annualized return over a period. You're still just about tracking what the S&P 500 is going to be doing. So it's still, relatively, good position. You throw in the tax benefits to go along with it. That's the way we can get comfortable. Now, if it doesn't work and if we try to stress test it and it's somewhat reasonable and the model doesn't work and it breaks and we lose the deal, then, that's where you're going to have to pass.
Yeah, that's right. And that's where I think it's not getting over aggressive, especially when there's a bunch of people competing for the same product. And that's sort of then your basis is higher than it should be. And, and then you don't know what, how much you can really pull those levers and, get out of it. But yeah,
and that's what I'm a little bit concerned with right now is that, are we getting over our skis? Because, there's a lot of just future growth that's being priced in. And I can make a very strong argument, and I personally see we're going to see some growth, but it's complete speculation of what that growth is, what inflation is going to look like. And, if prices have appreciated, significantly over not just the past year, but the past 3 months and the past 6 months. And so there's a lot of bases that are just much higher than they traditionally have been. And, if what has occurred over the past 10 years continues to occur, then yeah, everyone will be fine. But, you can't just go on forever. It's not a straight line, oscillates up and down. Like you said, there is a cycle. That super cycle can be trending one way or the other, but, it can trend, up for a short period of time in a negative way. And if you're not structuring the deal in the right way, if you're using, very short-term debt, that may be, floating rate, you can find yourself in a bad position pretty quick. So.
Yeah, that's right. And that's the stuff that's super important to pay attention to because, and I think that's just all of the different layers of these deals. It's like trying to find good real estate that's well located, that meets all those things, and then making sure that your financing is appropriate and, the amount of leverage and, all those things. That's why I tell people, like, you complain about a 2% acquisition fee or whatever it is, like it's a lot of work. It's a lot of work to, a lot of things you got to look at to uncover to even find a deal that you potentially can take down. And then, it's a lot of effort. And I think that's why just being, we had a good run, but just being more realistic about what the return expectations are and those sorts of things. Because that's all you're hunting is 15, 18, 20. I mean, once again, you'll find people that are quoting that. And I think that's the danger in it, as far as I'm concerned, is that it's not, like you said, it's not hard to change literally your exit cap, 10 basis points and have it, it's amazing how sensitive these things are. So it's not hard to financial engineer it in Excel.
Yeah. No, because, like an exit cap, you think of it as like a linear progression. Okay, we're going to go, going from 6 to 5 is the same as going from 5 to 4, but it's not linear at all. It's on an exponential curve. And so especially when you're getting kind of below that 5% cap rate range, that curve really starts to accelerate very quickly. And so just a couple movements and a couple basis points, fractions of percent one way or the other, your purchase price is going to be way over what might actually make sense for that property. And so it's definitely a potentially dangerous environment. That being said, if you take a long-term approach and you're okay with a longer-term time horizon, you'll get out okay. I mean, you can overpay and if you're okay with holding on for it for 10 years, because in 10 years, sure, the real estate most likely will have appreciated and will be more expensive. But it's just we're not necessarily, or we may not see what's happened in this past cycle where, you model a 10-year deal and you can achieve the business plan in 3 years, which is what we've been seeing. That would be great if that continued. It very well may for a couple of years, but you just have to be prepared to hold on for a longer period of time to not take a loss and to mitigate risk.
Yeah, and that's another good point, right? Is that in the thick of that, that bull run, that was, you were seeing those sort of 3-4 year, and so everyone was starting to like bank on the fact that they were going to be getting these pops. Like, it's easy to get sort of addicted to that. That's a lot of fun.
Yeah.
But now I do think that that's where I'm telling everyone that will listen, it's just any deal that you got into even pre-COVID, it's just like you need to reset your expectations now. I mean, I know it's held well. I mean, it's just, I get it. Like, okay, well, multifamily's done well, and it's what, but it's still like, yeah, but we are on the, it's going to, it has to, right? It can't keep going up, right? So it's just, and the big thing is more about the timing. It's just just because it was a 5-year deal, and you're 3 years into it or 2 years into it or something. I mean, I basically would double it. Like, you just have to assume that some of these things, like you said, to now execute the business plan or, navigate this turbulence is going to be where you're just going to be in that deal longer than, that's the other part of it, right? It's just, that's not unreasonable either, right? To make a real estate investment and, to just go into it thinking, I might be in this deal for 8 years. That's not bad. And I know that's easier to say on the LP side. I think you probably, if they stop and think about it, they're probably more patient than the GPs. The GPs, of course, are chomping the bit if they can exit and sell the thing and make some money. That's where most of the compensation comes. But on the LP side, it's just, if you are an impatient LP, it just seems that can work against you. I think you need to reset your expectations to think, we might be now going into an environment where, I mean, if once again you find good sponsors who are good at finding high quality real estate, right, at a good price, there's nothing wrong with hanging on to that real estate for 8-10 years. Like, that's not, we saw with the OZ stuff, the OZ fund stuff, like the big thing was like, oh my God, 10 plus years. I can't even, like they just couldn't do that. I don't have that patient of capital. I can't wait 10 years. It's like, it's kind of weird.
Yeah. And, 10 years, it seems like a long time. I mean, it is, but it happens quicker than you think. I mean, 2010 doesn't seem like that long ago to me. And so, I think having that, just the understanding that time horizon, you have to just take a longer term approach, and sure, there might be an opportunity sooner rather than later. But again, it's coming back to, hoping for the best, but planning for the worst and preparing yourself. And I mean, just like you said, sponsors, we're going to make the most money, faster by, selling the project or, refinancing it or having some kind of capital event. So there's an incentive there. Mm-hmm. But at the same time, like when we'll show an opportunity to partners, we'll underwrite, a 10-year hold and say, look, we'd love to exit this deal in 5 years, but let's look at the 10-year hold and let's all be comfortable with this. Because if we're not comfortable with holding on longer, I don't want to be in a position to say, hey guys, we said the business plan was going to be, X amount of years, but we have to hold on. And just one thing I've learned is I can't time things. Humans in general, we're bad at timing events. Yeah. I've been the most successful in investments where I've just tried to remove time as a variable as much as possible. If I've tried to trade stocks, I lose every single time when you're trying to time something, just because you can't predict the future. There's so many variables. And so just remove that variable of time as much as possible, and just take from a lens of something bad around the corner may happen, and can you get through it? And if you can get through it and you're comfortable with what that looks like, then okay, maybe it's a deal. But if it only works with the best case scenario assumptions, then it's just a recipe for disappointment. Yeah,
that's right. So how about like post acquisition for you guys? I mean, I guess I should back up. Like, all you do is multifamily?
So on the sponsorship side, all we do is multifamily. I'll invest, through Gray Capital as a limited partner. We'll provide JV equity for some other asset classes in different sectors. medical office buildings are our kind of second sector and asset class that we are involved in, as well as some industrial. But we're just really just passive limited partners in those projects. Kind of the day-to-day acquisition criteria for Great Capital really is just multifamily, market rate multifamily.
Yeah, and then you get, so on that property management side, do you do the property management yourself, or do you use third-party property managers?
We use third-party property managers right now. We'll probably bring property management in-house, at some point here in the near future, just because our trajectory and the way that we're scaling. We have some really great partners that are, in the property management space. We'll occasionally do joint ventures with them, but we are also invested, with these property managers in other ventures and other projects. So we have a pretty close relationship. So we have a handful of trusted third-party managers that we use.
Got it. Yeah, and I guess it's sort of the segue then into, I mean, for you, post-acquisition then, what are the big things that you're focused on to ensure that business plan stays on track? Or said another way, like, what are the things that you do to sort of mitigate some of these risks that are inherent? I mean, kind of your go-to strategies or tactics, so to speak.
Yeah, the biggest thing, and this is simple, is just, communication, not just communicating with, if you're using a third-party manager, yeah, you can communicate with the third-party manager or their regional manager, but you have to have constant communication with the on-site team and, and make a presence. I know a lot of groups that are relatively hands-off, letting the on-site teams just kind of run things, or maybe just let the third-party management group kind of just really run the show. We like making a physical presence at our properties, pretty consistently. You can learn a lot from reading a report, talking to the team, but you never learn as much compared to when you actually go on site, tour units, walk around the property, and sit down with the staff and, take them out to lunch. And so just having that, personal connection and just being present, being on site. And it sounds pretty basic because it's real estate, obviously it's like a physical thing. Why wouldn't you be at that property? But it's so typical to hear, from ownership that, they've never even been to the property. They've went to the property once, or they're going to go, once a year, or maybe, once a quarter. And that can work. You can have the right systems and the right teams, and that can work. But I guess just one thing we like to do is actually just have that physical presence where we can really uncover things that you might not get out of a report.
Yeah, I mean, it's funny. Yeah, it's funny to say that out loud, as though, but that is what you hear a lot. Is just, I mean, and that's why you see people that live in one place and then they invest heavily in another place. But it's even people that are it's in their backyard, doesn't mean that they're driving down there every day.
Yeah.
To look at it, and that's sort of, I mean, I guess for guys like you, that's what you're kind of looking for, right? On the acquisition side, is looking for those absentee owners and those people who are sort of asleep at the switch, or they're just sort of mailing it in, and that's what creates all this opportunity. Is that these things require constant upkeep. I mean, you've got to be, things change, times change, tenant, needs and desires and amenities, and all those things change. And if you aren't paying attention, next thing you know, people are moving out and they're moving in down the street. And
well, it's like you go into a property now, and it's like you still see, for example, we went to a property that we had recently acquired, and it was near Christmas time, and there were boxes just piled up everywhere in the clubhouse, and we're like, what's going on? This is a nice property. What's going on with all these boxes piling up, and just the system to, handle package deliveries. And even if we have a, package locker system, but, it's not being used correctly, it wasn't set up correctly by the previous owner. And it's the type of stuff that, again, it doesn't show up in a report. If you call the manager, they're not going to say, oh, we're dealing with packages and boxes. But to residents, it's a little bit annoying every time they walk into their clubhouse and they have to, jump over boxes. And again, it doesn't seem like a problem, but the devil's in the details. This is a business of, it's not just nickels and dimes. It's, it's pennies and nickels. And so to be on top of those small details to, create that full experience for residents. And again, it's to show everybody that's involved that everybody's watching, and you're not just out there on an island doing it yourself. And because if they don't think management cares, or they don't think ownership cares, why should they care? But if you start from the top, if everybody cares, ownership cares, management cares, then on-site team cares, and then that shows and translates to the residents. Yeah. You're going to see higher retention. And again, that's hard to factor into a business model. You can't model that. There's no line item. But
but it's the whole culture thing, right?
Yeah.
In the community, and it can't be understated. I mean, like it's so important, right? Like these are. It does make a difference, like how one owner will run a property versus another. Those little things or the soft things make a big difference, because it's a community of people, and
exactly.
There's a culture that exists whether you realize it or not. And and especially when you're taking a property over, I mean, oftentimes that's why you're able to buy it at the right price, is because that part, they didn't get that part right?
Yeah.
And so then you have to go in, and it's a delicate balance, because you certainly don't want the residents revolting and sort of if you do things too quick, too soon, and all that kind of stuff, like all those things matter. That's why I always say, like, when you're looking at assessing a sponsor, especially I think like in the mobile home parks, guys doing that. I mean, but even multifamily, you're looking for someone on the squad who's a deft communicator, like someone who really understands. I mean, if the asset manager that's going to, like, this is the asset manager and there's robotic and whatever, it's kind of like, maybe you're more of a office guy or industrial. Mm-hmm. I don't know, some other asset class where you can kind of be more rigid. But going in, especially the deeper the value add or any of those sorts of things where you're going to turn it over and that's your business plan, if you don't know how to go in there and turn the culture around and get the community behind you, and because that's what it is. Yeah. It's just like that's a big part of. That's how you create value, right? In most of these strategies, some of that's going to have to take place, right?
Yeah, no, and that's a major challenge, and it's so easy to divorce, the property on a spreadsheet, and just from the numbers to like the physical, and then the actual people, that make up that community, and like you said, that culture, and then like a major value add reposition when you want to go in and fix the place up and then try to raise the rents by $150 or $200. You have to acknowledge that okay, you're going to be displacing some residents, and maybe that's the goal. Maybe that there's residents in there that you don't want in there. But occasionally we've had a couple properties where there has been a really great sense of community at the property, and how do you go in there and execute your business plan but still try to retain that sense of community and keep the things that kept people there? And maybe they can pay more and maybe they can't, but you have to be creative, which I think gets lost a lot in this industry, is there's just not enough kind of just creative thought and separating the analytical, just looking at spreadsheets from these are living, breathing communities. Yeah. And it's sometimes intangible how to add value. It's not always just new paint and new floors, rents go up by $100. It's, how do you make a desirable place to live? And then that's going to translate to a desirable property to eventually sell to another buyer. You'll get a better return if you take a more holistic approach to investing. I mean, it's got to be a good investment. I mean, we're in this to make money and to get good returns and everything, but if you're not looking at the full picture, you're going to miss something.
Yeah, that's just it. I mean, it's going to, if you don't pay attention to those things, it's going to show up someplace in the stats, right? Like the performance won't be as good as it can be. I think that is an area that I think a lot of people aren't that great at. Like it's not a skill that everyone has, because if they are just spreadsheet people, whatever, they'll overlook those things and they'll wonder why they're not getting the results that they hope they should or would. So for you, I mean, what's the thing that keeps you up at night? Like, in this business, like what's the thing that that you makes you the most nervous, right? Like about any of this that yeah, I'm
Yeah.
just curious, like what is it that you are like, is it that package thing or little things like that, or it's, what is the stuff that, yeah, that keeps you up at night?
Yeah. Well, there's some of the macro risks out there that I'm concerned about, and I'm not, I try to sleep, pretty well at night, just in general. But, the political environment is something we watch pretty, closely, and I'm not a big kind of doomsday person of, one party's going to get in control and kind of absolutely screw everything up. But, policies, rent control policies certainly do concern me. Just kind of the erosion of, property rights that does concern me. Not as much in the markets that we operate in, but we're in Indiana. Illinois is right next door. We don't operate in Illinois for some of those reasons. Between just the state government just not having their stuff together, and there's huge unfunded pension liabilities. They can raise property taxes significantly, kind of in a blink of an eye, and the fact that they could implement rent control kind of any day and really inhibit our business plan. That's concerning to me for sure. And then our individuals, as they get older, millennials specifically, are they going to continue wanting to rent apartments as opposed to buying homes? Now, I think a lot of them are priced out of buying homes, but that the millennial demographic group is the largest demographic group after the baby boomers, and those baby boomers, well, they're moving to a point where they may be renting apartments or moving into senior living facilities. The millennials, they're moving into the prime home buying age, and age where they're getting married and having kids. And the new generation, Gen Z, which they're in their 20s now, it's just a smaller demographic. It's a smaller generation than the millennials. And so do they become, are they going to rent like millennials? I think that they probably will, but there's going to be less of them. And so it's what are the millennials going to continue to do? And I'm a millennial, but I own my own home. And so that it'll just be interesting how those just major demographic moves continue to play out over time.
Yeah, very good. Cool. Anything we haven't covered that we should? I'm trying to think of any other good stuff you got going on, or trends or things that you're kind of taking a look at that you might explore.
Yeah, well, I mean, we're tracking like everybody is, what inflation is doing right now, and I guess another major risk is what like the 10-year Treasury is going to do. It's one of the most important figures in all of capitalism, really. Just the price of capital and all the loans that these multifamily properties are typically based off of or indexed to the 10-year Treasury. And it's still low historically, but compared to low cap rates, it's becoming very hard to do deals. And if it continues to rise up, and if it gets well over 2, closer to 3, like it was not too long ago, I think back in 2018, I think it was closer to 3, that could certainly be disruptive to the market. Then on inflation, so it cuts both ways. But if we already see inflation, we know there's already inflation here, but it's how much and for how long. Is it going to be transient, just a couple months or to a year? We're going to see higher prices because of just the supply constraints related to COVID, or are we going to see some overextended longer term inflation? And that concerns me from individuals and just people, and what that can do to the economy. It's good. It's a driver for multifamily and apartments. Multifamily is a hedge in real estate in general, but multifamily specifically, because you're releasing every year, you can beat inflation. So that top line revenue growth is going to increase. The value equation, NOI divided by cap rate, gives you your value. So as rents increase, NOIs increase. You can even have cap rates going up, but the prices will still go up as long as that NOI continues to increase. And so that's what we spend just a lot of time trying to figure out. Okay, what is the growth going to look like? We know we're probably going to hit more than 3% organic rent growth, which is what typically is what the average. But is that 4%, 5%, 6%? Is that for a year, 2 years, or 3 years? Yeah. And I think that's what's pushing a lot of these the price increases and all the FOMO and all the buying that's going on. The only way you can really justify it is if you say, okay, well, we're going to have 5 years of 8% rent growth, and maybe that'll happen, but that's pretty aggressive, and it's a lot of speculation.
Yeah,
so.
that's pretty darn aggressive. Yeah, I
Yeah.
agree. Cool. Well, where can people find you, Spencer?
Sure, yeah. I mean, we're all over social media. You search either Spencer Gray or Gray Capital, but you can hop on over to our website, graycapitalllc.com. That's probably the best place, and we have a pretty awesome newsletter if folks would like to sign up. Goes out every week, keeps everybody up to date on latest trends. We look for all the latest research reports, kind of give market updates, benchmark rates, and things like that. So, graycapitalllc.com.
Very good. All right, man. Well, appreciate you taking the time, and you have a good one.
Yeah, you too, Lance. Appreciate it.
Take care.